Hello, everyone, and welcome to Schwab Coaching. My name is Cameron May. I'm a Senior Manager of Trading and Derivatives Education here at Schwab, and this is Getting Started with Options. And today we're going to be talking about how options prices are set, what causes those prices to change over time, and also we're going to discuss the role of that shadowy figure known as the market maker in setting prices. I think this is going to be a really important discussion. I encourage everybody to listen all the way through. Before we can get to any of the discussion, though, let me first of all say hello to everybody that's already chatting in out there on YouTube. Great to see some familiar names out there. Nice to see anybody who's here that's might be new, but hello, Jay Richardson, Lewis, Josh, Mighty Quinn, Janelle, Richard. Who else is out there? JV Texan, Eva, everybody else. Thanks for joining us week after week. We always appreciate your attendance and your contributions to these discussions. I also do want to say, if you are among those that are here for the very first time, I want to welcome you as well. And if you're watching on the YouTube archive after the live stream is concluded, enjoy the recording. It's a great way to watch these webcasts, but you're certainly invited to join us in the live stream audience if you'd like to be here. This is a Tuesday webcast series, and we kick things off promptly at noon Eastern time. Now, I also want to let my live stream audience members know that my great friend Mike Fairborn is hanging out in the chats with us. Mike's keeping an eye on any questions that come in. If I can't get to those questions, Mike's there to pick up my slack for me. We've been working together now for the better part of 2 decades, so Mike brings a ton of experience to this. Thanks for being there, Mike. Mike and I would also like to issue an invitation to everybody listening live or on the recording to follow your favorite Schwab presenters on social media. You can find Mike and me on X. You can find Mike there at Mike Fairborn CS. You can find me on X at Cameron May CS, and you can also find and follow me on LinkedIn. Just go to linkedin.com/in/Cameron May CS. But let's get into this discussion. And as we do, of course, we need to consider the risks associated with trading and investing. Bear these important disclosures in mind. Options carry a high level of risk and are not suitable for all investors. The information here is for general informational purposes only and should not be considered an individualized recommendation or endorsement of any particular security, chart pattern, or investment strategy. Schwab does not recommend the use of technical analysis as a sole means of investment research. Investing involves risks, including the loss of principal, and any investment decision you make in your self-directed account is solely your responsibility. All right, so here's what we're going to be doing today. We're going to be putting ourselves in the shoes of an options trader who's about to buy a call option, but they just want to know, what is it that they're paying for? How does the market establish the price for the option that trader is buying? And then how might that price change over the time frame of the contract? What are the influences? Can they be measured? And finally, how are those prices impacted by that entity? I'm going to say entity for now, known as the market maker. What is a market maker? What role do they play? And how do they accomplish it? That's a lot, all right? But all of that is really important. Janelle says it's story time. Yep. Yeah, it's a settle in, children. Here we go, right? Let's go right to the thinkorswim platform. And let's just put ourselves very rapidly in the shoes of, let's say, a would-be call buyer. And they've taken a look at NVIDIA, just as our example stock. Maybe they see this been going back and forth between about $170 and $195. And let's just say they think the stock is going to go up from where it is, right about 175, maybe up toward 195 again, like it's done so many times over the last 6 months. Not a guarantee that it's going to do that, but let's say that's what they're looking for. And so they decide to go buy a call option. So let's go do that. Let's go to our trade tab. Let's make sure that we're looking at NVIDIA's option chain. And with a move maybe anticipated to happen by, mid-April, let's make sure that we buy a contract. Let's go out to mid-May to make sure that we have enough time on this contract. So I'm going to go out here to the 15th of May, and stock's trading about 175. Let me pick on the $170 call for just a moment. Looks like that's trading for between $13.45 and $13.55. Let's say it's $13.50. That price is going to change as we're talking. So I'm going to put this in here as our example trade. The long call. And let's say we buy the NVIDIA 15th of May 170 call for $13.50. All right. Let me widen this out just a little bit. So that's what I want to focus on today, because has it ever occurred to you as you're placing a real trade or a paper trade, wait a minute, how do I know I'm paying a good price for this? Is it overpriced or underpriced? How did they determine the price on this option in the first place? Well, that's actually done according to a very specific formula. It's an algorithm invented by a pair of gentlemen named Fisher Black and Myron Scholes. They actually won the well, Fisher Black didn't, unfortunately, he died. But Myron Scholes won the 1997 Nobel Prize for Economics for coming up with this formula, but it was for the standardization of the pricing of options. So if you ever have the feeling that this is random, it's not random. There's a little bit of flexibility in it for the market maker, but that's about it. Right? So how do we come up with this $13.50 as the value for this option? Well, this option actually the value consists of two primary components. And to explore that in a little greater detail, we have to see what we're getting for this option. So theoretically, what the trader is paying for here is they're paying $13.50 per share for the right to buy 100 shares of NVIDIA at $170 per share for the next 52 days or through the 15th of May. So if NVIDIA right now is worth, I'm going to do a little bit of rounding here. Let's assume NVIDIA is at $175, which is pretty close. You notice I'm only rounding a few pennies here, right? That's going to change as we're talking. But if we've just paid $13.50 for the right to buy shares for $170, we know that we're getting a discount on that share price. We can buy the shares for $170. They're worth $175. That's what we would call the intrinsic value of this contract. It's giving us a discount of $5. Well, according to my math, there's something left over there. We didn't pay $5 for the contract. We paid $13.50. So that means there's $8.50 that went towards some other value. What is that value? Well, we need to talk about that. That's sometimes referred to as the time value, probably more accurately referred to as the extrinsic value, because time value only partially describes what we're getting as a value from that portion of the contract. But we can see, so there are two elements to the price of this option. There's the intrinsic value, the $5 here, and then there's the extrinsic value, the $8.50. Intrinsic, very easy to explain. It's the price of the stock minus the strike price of the option. So if the stock's at 175 and our strike price is at 170, there's $5 of intrinsic value or $5 discount for this call that we're buying. Now, if price happens to be below our strike price and we attempt to subtract that, it actually reveals that there would be no intrinsic value in that contract. Yeah, actually, these out of the money options where the strike price is above the current price of the stock, these have zero intrinsic value, and they actually consist exclusively of this extrinsic element. Even more important for those traders to understand this element. So where does the $8.50 come from? There are basically two primary determining factors in assigning a value to that extrinsic element of the contract that we're buying: time and volatility. But there's a third one that kind of gets ignored: interest rates. Three things that we need to bear in mind, though. All right, so first of all is time. That's why it's sometimes called the time value of the contract. We're paying $8.50, and for that $8.50, we have the right not to just buy the stock at $175, but at any time for the next 52 days. That means right now we have a $5 discount, but that discount might grow, and it could grow exponentially in the next 52 days if NVIDIA takes off and runs. Right? So that time contains within it value for the investor, at least the potential for value for investor. And the more time, the more value. So yeah, that's why we might have to pay more for a May contract, and we would have to pay more for a May contract than for a similar contract in April. So time certainly plays a role. So does volatility. Now, if we have the right to buy NVIDIA for $170, and it's right now at $175, and we have 52 days in which to buy those shares, Well, let's put ourselves in two different scenarios. Let's suppose that we look back over the last year and Nvidia has been $175 every day for the last year. Just hasn't gone anywhere. There's no volatility in the stock. Obviously, that's an extreme scenario, highly unlikely. It's not at all a description of what's happened with Nvidia over the last 12 months. But just imagine that. Well, how much actual potential would we expect for Nvidia to move over the next 52 days if over the last 365 days it had done absolutely nothing? We actually might not expect a lot. So the volatility also contributes significantly to the expected value of the contract. Yeah, so just having time on a contract isn't enough. When a stock is more volatile, or if it's just expected to be more volatile, the value of the contracts on that stock will be higher. I think that makes sense. So if we change up our scenario and we assume, if we look back over the last 365 days and we notice, boy, 6 months ago, Nvidia was a $50 stock. 6 months before that, it was a $300 stock. So it's just up and down all over the place. And if our timing is right, if the stock goes for another big, nice run, as it has a historical possibility of doing, that's a more valuable contract. And that's built into the formula that Black and Scholes established. The volatility expectations of the traders influence. And it's actually not just their expectations, it's also how much has this thing moved in the past. So time plays a role in establishing the time value of the contract. Volatility certainly plays a role. But then there's also, now user says, is there a general guideline for high volatility? Not general, like a value that I give you, 15. It's a random number generated entirely from thin air. But comparing a stock's expected volatility, where it has been and where it is now, yes, an investor might do that. As a matter of fact, we can chart that, and I don't mind doing it. Let's go to NVIDIA. We can come right up here and use the tool known as implied volatility. If we add that to our chart, that gives us a line that shows us, right now I'm on a 6-month chart, but this is showing us expected volatility levels for basically a 30-day period on NVIDIA. Right now, expected volatility levels are relatively low. It's also known as implied volatility. Relatively low, that's making each day a little less valuable, and it's bringing down the price of the extrinsic value of the contracts. Very good question. But there is a third element. There is a third element in determining, how we got to that $8.50, and that is interest rates. What in the world do interest rates have? Why would they play a role in the pricing of an option? Well, part of what earned Scholes his with the help of Black, but his Nobel Prize was the recognition that options traders and options investors could have done something else with their money, and they should probably be compensated for the opportunity cost of what else they could have done with their money. Now, obviously, if we're putting $1,000 into a long call, we could have put that $1,000 into, let's say, a highly speculative real estate position. Well, they can't make that assumption. So the model actually builds in compensation for returns that might have been achieved by investing that $1,000 or whatever into, let's say, a short-term treasury bill. Something that's a little bit more reasonable for Black and for Scholes to assume as an opportunity that was surrendered in pursuit of this option. So if that opportunity is comparatively stronger, if T-bill rates go up, options prices actually go up a little bit, not a lot. Okay. And if the short-term government fixed income security rates go down, your yields go down, options values also go down a little bit. Now, for most options traders, it's such a minor impact, it's not even really a consideration. What they're more interested in is what's the length of my contract at time and how volatile is the stock, the volatility element. So all of that goes into the pricing of the extrinsic value of the contract. So if there's no time left, this contract would just be a $5 contract. If the volatility were zero, even the extra time wouldn't have any value, and the value of the contract would still be $5. But that's important. Now, interest rates, if you want to we'll show how to measure these. I think it's natural to say, well, if this is how, yes, Lewis says, would this be measured by something called rho? Yes. It's natural once we understand the concept of how options are priced and how those values might change. Well, how can we measure those values? Because we know that if the stock is at 175 and we have the right to buy the contracts for 170, well, if the stock goes up, now we're getting a deeper discount. Our intrinsic value is increasing. At the same time, if we buy a 52-day contract and then we wait, well, now time is going by and that contract, the extrinsic value is becoming less valuable. How much less valuable on a daily basis? And if volatility rises or falls, to what extent does that impact the value of our contract? These are important things to understand. And all of these can be gauged using something known as the options Greeks. So let's go acquaint ourselves with those. Let's go back to our trade tab. Let's look at our 15th of May 170 strike. And I'm going to add the Greeks right up here where it shows us this is our last price and the net change in that price for these options. I'm going to go up here and change these two columns to the Greeks. Now, do we have anybody here that's brand new to the Greeks? Totally fine. Everybody's somewhere along their own personal learning curve, but I want to make sure, even if you're not here in the live audience, if this is somebody's first introduction to the Greeks, I want to try to make these as digestible as possible, but I also recognize not everybody latches on to every concept the first time through. So a nice thing is, if you need to go back and revisit what we've discussed, you can go back and catch the archive for this webcast. So let me just show you. If you need to go see that again, first of all, make sure that you're subscribed to our Trader Talks channel on YouTube. That's where you can join our live streams, and you can also find the playlists of previous webcasts. So Trader Talks, Schwab Coaching webcasts. So you can just pop down below the video stream right now, click on the subscribe button. It only takes a second. Doesn't cost anything to do that. But you can go to the playlists, and for my webcast series, it's kind of way down at the bottom of these playlists. It's called Getting Started with Options. There it is. And you click on View Full Playlist. And not too long after this one is concluded, you'll be able to find its archive right here at the top. All right, but let's go get acquainted with the Greeks. So when I choose the Greeks from this menu, it gives us, let me hide this for just a moment. Gives us delta, gamma, theta, vega. I'm going to add one more. Let's go up here, customize the column set. And there's the last one that someone mentioned, rho. Let's add that. I'm going to leave it at the bottom because for some, they might consider it to be sort of the least important. But I'll just click OK. So there are our 5 Greeks, delta, gamma, theta, vega, and rho. And let me help you anticipate how these are going to help us calculate changes in our option value. Delta starts with D, so does dollar. It helps us measure the impact of a $1 increase in value on our stock. Gamma starts with G, so does gear. It actually gears up our delta, increases the impact of a dollar move or decreases the impact of a dollar move. Theta starts with T, so does time. So it shows us the impact of time, of the passage of time on our option. Vega starts with V, so does volatility. Shows us how much an increase in the volatility of the increase in the expectation of volatility can increase the value of our contract. And finally, rho starts with R, interest rates. Yep. All right, so start with delta. Delta can actually show us a couple of things. One thing that a trader will sometimes do is they'll look at their delta, and that'll give them approximate likelihood that a contract will still retain some value at expiration, or in other words, it'll be in the money. There's about a 63% chance that our 170 contract will be in the money at expiration. But another thing that it can do is tell us how much a $1 move on our contract, on our stock will impact our contract value. So if we just bought this contract for somewhere around $13.50, and maybe I'll say this way, our Greeks always assume something positive happened. Price went up, time went by, volatility increased, rates were increased. Now, I'm not saying positive as in something good happened. I just mean like a mathematical plus or minus, positive or negative. Does that make sense? All right. So delta assumes a $1 increase in the stock. So if we buy this for $13.50 and if we get an immediate pop of $1, how much of a return does that generate on our option? 63 cents. Hey, a 63-cent return on a $13.5 contract is about a 5% move on a $1 move on a $175 stock. So the stock barely budged to 0.5%. And we got a 5% increase in the value of our option. So that's the significance of delta. Now, if the stock can also go down. So in that case, we might lose 63 cents. So, but this is helping us gauge how one of the variables that influences the pricing of options has that impact. That's delta. Gamma helps us gauge the next dollar. So this is the gear. One thing that we need to know is that these numbers are always changing. You'll see some of them change as we're talking. And so what a trader can say with a high degree of confidence is if they buy this call and stock goes up $1, if it does it quickly before the other variables can have an impact, they should be looking at a 63-cent unrealized gain. But what if it goes up a second dollar? Well, the delta will change by then. And this is how much it will change, 1 cent. So the second dollar, we'd say, all right, we made 63 cents on the first dollar. On the second dollar, we make 64 cents because gamma has geared that up. Now, if prices are falling, it works the opposite way. If the stock price falls $1, we lose 63 cents on our call. On the next dollar, well, our call has shrunk in value. And so there's not as much left to lose. So the next dollar drop will cost us 62 cents. We subtract the gamma, we're gearing down. Does that make sense? So if you caught gamma, that's about the most complicated of the Greeks. Congratulations, you're probably over the hurdle. Because theta, vega, rho, I think these are going to make pretty good sense. Theta starts with T, and it always assumes a a 1 day passage of time. So if we buy this contract for $13.50, price doesn't change, but we wake up tomorrow, how much is the contract now worth? It's worth 10 cents less. Yep, time doesn't ever go in reverse. My apologies. This is not ever going to switch to positive unless we sell a contract. But for the buyer of the contract, it's always going to be a negative number. All right, so there's the impact of the passage of time. Vega always assumes a 1% increase in our volatility expectations. So if this were to uptick by 1%, this would be the outcome. So a 1% increase in implied volatility means that investors are expecting more volatility in the future, and more volatile stocks carry more value, more potential value for options. And so it increases the value of the option to the tune of 26 cents on that 1% increase. If the volatility expectations drop, it drops 26 cents. Now, finally, we have rho. Rho, it doesn't look entirely inconsequential. 12 cents is at play here. Rho assumes a 1% change in interest rates. Okay? How likely is that? This contract runs through the 15th of May. There's actually one Fed announcement that's due before the 15th of May. It's on the 29th of April, so that's in about a month. And right now it looks like there's less than a 10% chance of any change to the interest rate. So probably no impact from rho. But even if we did get, it looks like the most likely, if it's not just interest rates staying steady, maybe interest rates go up. Yeah, up 0.25%. There's almost no expectation from most market observers that we get a rate cut anytime soon. So if we go up 0.25%, our contract might go from 13. Let me make sure I'm on the right row here. I think I was accidentally pointing the wrong one, but that's okay. Close enough. You're getting the point. if we go up 0.25% in interest rates, we might get a 3 or maybe a 4 cent change in the value of the contract. Maybe. In the unlikely event that interest rates change, 3 or 4 cents. Guess what? Price, time, volatility have probably already had a much larger impact than this. Yeah. So for most options traders, they may not even display this by default. I'm going to go ahead and customize the column sets and take row out of there. Okay, there we go. So these are sort of the real drivers of price. And once we understand intrinsic versus extrinsic and what changes intrinsic and extrinsic values, we really start to get a gauge for how options prices are set and how they can change. We now recognize the real things at play here are the stock price relative to our strike price, the number of days we have and the passage of those days, and how volatile the expectations are for our stock to be and how that volatility changes. That's it. Those are the three big variables. So all of this adds up to the establishment of what we might call a fair market value. And I'm going to come back to that concept in just a moment, but I want to do a little exercise first. I want you just to test. Let's test yourself for just a moment. Let's say that we buy our option for $13.50 right now. It's moved a little bit at the moment, but let's just say $13.50. Let me throw out some assumptions here. Let's say that our stock goes up $2 over the next day, while volatility drops 1%. So stock goes up by $2 tomorrow, volatility drops 1%. What would be the net return on this contract? Let's do some math. So stock goes up the first dollar, we make 70 cents. Awesome. It goes up a second dollar, we make an additional 71 cents. That's $1.41. Are you following me so far? So far, doing well. It took a day to make this move, so we have the time decay there. So we go from $1.41 down. We lost 10 cents because of theta. Now, finally, our vega, we assumed we went down 1% in vega. So before that, we're so far up $1.31. Since volatility dropped, it made our contracts less valuable, less volatility, lower values. Like we'd subtract 23 cents from $1.31. What would that leave us with? $1.08 net gain over the next 24 hours. I am at the wrong strike. You're right. Thank you, Paul, but close enough, right? Yeah, look at this. Let's redo it. Repetition never hurts, right? 63 cents on the first dollar, 64 cents on the second dollar, up $1.27, minus 10 cents, up $1.17, minus 26 cents gets us down to about, 89 cents? Still a positive outcome? No, I was on the, yeah, right. Boy, I'll tell you, when you look at the camera and then you look back down at your option chain, your eyes tend to drift. I'm learning that lesson right now. In any case, I was off by a penny. So about 90 cents. About 90 cents, something like that, right? You can go through that again. I did all the math in my head. I kind of wandered across one or two of the lines. My apologies, but you see what I'm doing there. And so what this can do is it can allow the trader to sort of estimate future values of contracts. Buy them now, estimate future values. But the Greeks are very limited because they change so much. What if we're not talking about a small move over a short period of time? What if we're talking about a larger move, such as moving up from 175 to 195? That's a $10 move, and maybe we're expecting it to take a month. Ooh, wouldn't it be nice if we just had a calculator? Janelle, thank you for the reassurance. I know I was off by a penny or so because I wandered across a couple of lines. I think the concept, though, that's the point, right? Anyway, yeah, the Greeks are nice. They really do provide important insights into how these things are priced and how those prices change. But once we understand that, now you have my permission to learn about a calculator that'll skip through that. And that calculator is found right up here. Instead of using the Greeks, we're going to use a calculator known as Theo Price. And this Theo Price tool, you'll see it displayed here right now. Let me just quickly click on that and click the reset button. So it just takes us right back to no assumptions. But look at our correct strike price, the 170 strike. Right here is the current value of our contract. So right in the middle is about 13.55. Let's plug in some assumptions about price and time and volatility. Let's go up here to our Theo Price tool. And let's say that the stock does go up $10. See, we thought it was going to go from 175 to 1. Look at my math. That's 20 bucks. $20 from 125 or 175 to 195. Let's assume that it takes a month to do that. So let's go from March out to April. And let's just give it a full month. Let's go to April 24th. So up $20 in a month. And let's say during that time, I don't know, let's say maybe volatility drops a few percentage points. There we go. Let's go with minus 3%. What this does as we type in those variables is it spits out a highly accurate future fair market value for this contract. $26. 26.10, 26.11. So we paid 13.5. This thing has now essentially doubled thanks to the price move that has compensated for the passage of time and for actually a negative impact from volatility. So this is a nifty little Theo Price tool. It's for calculating theoretical future prices on options. So all of this is to really understand how options are currently priced and how those prices can change according to those three important variables: price, time, and volatility. Now, with all of that, we arrive at something known as a fair market value: current fair market value, future fair market value. And if we were dealing with a perfectly liquid market, those would be the fair market values. If we went to buy the contracts right now, they'd be $13.50. If we went to buy those contracts a month from now, assuming the stock had gone up $20 and assuming volatility had dropped 3%, we'd be paying $26 and a few pennies. But are markets perfectly liquid when we have human beings involved, or perfectly balanced? Nope. If we always had exactly the same number of buyers and exactly the same number of sellers, that fair market value would be highly accurate. However, the options market, like the stock market, is not always in perfect harmony or balance. And so sometimes, let's say that we are this trader who's decided to buy a call and we see the fair market value of $13.50 and we go to buy that call. Well, there has to be someone on the other side of the equation, the other side of this contract, willing to sell that call at that price. And that would have to be, that would rely on some pretty strong coincidence that the number of buyers and number of sellers are always exactly in balance to provide a marketplace for each other. So because there's not always that balance between buyers and sellers, we have this other entity involved, an intermediary known as a market maker. Now, how many of you have heard about a market maker? And you probably have seen one on the street before. You can recognize a market maker because they wear a long black cloak and they have a hood over the head at all times, long bony fingers, carrying a long-handled sickle that they just probably were harvesting some wheat with. I think you get the message. Yeah, they're evil. No, they're not evil beings. Their purpose is to provide liquidity in the options market. All right, that's the role that they play. And so the way that they provide that liquidity, the way that they make sure that when buyers want to buy options, those buyers are able to, and the way that they make sure that sellers who want to sell options are able to sell those options, is that they take the other side of the trade probably most of the time. That's actually the role of the market maker. So if I go to buy a call and there's not a seller waiting for me, in order to quickly get that order filled, the market maker sells that call to me. You think there's some risk in taking that position for them? Of course there's risk. Yep. So here's what the market maker does. They take that fair market value and they sell to buyers at a slightly higher price than fair market. And they pay to sellers a slightly lower price than fair market. So they're compensating themselves for initial risk because what they're trying to do is quickly match up. If they just bought a contract, they'd like to sell that contract, but they also take offsetting risk positions in other ways by buying and selling stock and that sort of thing. But their job is to act as the intermediary to provide liquidity in a market. Now, sometimes that market is less liquid, and sometimes there's a strong imbalance between buyers and sellers. So here's what they'll do, and the way that you'll see the market maker selling at higher prices than fair market and paying at lower prices is that you'll notice a difference between the bid price and the ask price. So typically, when we buy, if we just want to pay the market maker's price for an option, that's what the ask price is. Market maker saying, hey, I'm asking this price. So for the 170 right now, they're asking 340. So if we pay that price, we buy the option. Now, at the same time, if we want to sell an option, the market maker is offering, they are bidding 1325 for that contract. So you'll notice it's less. What they're doing is compensating themselves for risk. And that risk widens as there's poorer liquidity. The harder the market maker has to work to try to bring buyers and sellers in, the wider they'll make that spread. So now as let's say they buy options, they will build up an inventory of options that they haven't been able to sell off to someone else yet. So if they've been doing a lot of buying, let's say there are lots of people trying to sell contracts, the market maker is building up a large inventory of contracts, they will change the prices a bit, move them further away from fair market to try to discourage additional selling. How do you discourage additional selling? Lower the ask price, right? Lower the bid price. Lower prices overall. If prices are lower, people are less inclined to sell. If on the other hand, the market maker's been selling a lot, if there's a heavy demand from buyers, maybe they need to raise the price, raise the ask price, and bring that bid price up as well. So there we go. Now, the final thing is sometimes you'll see these the bid and the ask just drift apart. And what the market maker may be simultaneously attempting to do is if there's a highly illiquid market, they may not want to buy from anybody. They may not want to sell to anybody as much, slow everything down. They widen that spread. What they're doing at the same moment is they're asking buyers to pay higher prices, and they're requiring sellers to sell at lower prices. That slows down trading activity in an illiquid marketplace. So when you see a wide spread between the bid and the ask for lots of veteran options traders, what that tells them right away is they're probably dealing with an illiquid market. Now, in all of this, as I'm explaining, Barbara asked an excellent question. Are market makers real people or is this automated? That's an excellent question, Barbara. A market maker isn't really so much an individual anymore. It's typically a firm that fills this role. And they use obviously highly sophisticated algorithms. My guess, although I haven't confirmed this, is that they're now using AI to assist with that. I don't know that for sure, but it's algorithmically determined. So these changes, these changes in price, the purchases, the buying, the selling, the changes in price happen much faster because it's an automated, mechanized process. So it's not a human being. I've actually known those human beings, market makers from back in the day, decades ago. This was a person sitting there at a computer that would make manual adjustments. That doesn't happen so much anymore, but there are still human beings behind the market maker process making adjustments according to, they might say, hey, our inventory is getting really large on one side or the other. Let's kick up that algorithm a bit, or maybe their expectations for risk are growing, so they might want to widen their spreads, those sorts of things, but largely automated. Yeah, Paul says it's a program, even if it's not AI. That's accurate. Yep. There you go. Is that helpful? It's not you in battle with another human being trying to make or lose money. This is just a firm attempting to provide liquidity to a marketplace. There we go. Option 66 asks this question: what do you consider a reasonable bid-ask spread? What's the bottom line as the market maker is moving the ask and the bid around? Well, we'll notice that we can develop a spread. So there's our 170 strike. Right now, the price has gone down. And you'll notice if we were to pay the market maker's ask price right now, that would be $13.20. And if we immediately sold it back to them, it would be $13.10. That'd be a 10-cent loss in value. Price didn't move, time didn't pass, volatility didn't change. It was what we call slippage. And so for some traders, well, we need to know that's just part of trading options. There will always be that difference. Sometimes it's a narrow spread, sometimes it's a wide spread. So what some will use is sort of a rule of thumb, like maybe check to make sure that the difference between the two isn't, let's say, more than 5% of the ask price, or it isn't maybe more than 10% of the ask price. So for our contract, if we're paying $13.25, for someone saying they don't want this spread to be more than 10%, they'd make sure that the bid isn't more than $1.32, that's 10%, lower than the ask price. Jay Ritson, was that Greek's discussion important? I think this is one of those webcasts. I knew this when I kicked it off, that it's going to probably be important for a lot of people to go back and rewatch it to really process all of the details that we've gone into. Because when I decided to go through options pricing, the Greeks, the theoretical pricing tool, and the role of the market maker, who they are, what their motivations are, and how they might make changes to options values, I knew that was a lot. But Jatin says, hi, Cameron. Hello there. Does the probability change based on day-to-day stock movement? Okay, probability, yes, absolutely. Probabilities of the values of options strategies do change as price changes. Yep, and as quickly as price can change, the probability can change. Also, as time passes, the probability can change. Also, as volatility levels rise and fall, the probability can change. It's all important. Yep. Okay. User says, can you please show where you saw the $26 theoretical price for the option? I don't know maybe I saw something along those lines. I don't recall. Oh, I see. Yeah, just this theoretical price. Yep. So that was based on 3 assumptions. We buy the contract, and then a month goes by, price rises $20, and volatility drops 3%. This was relatively random. I just said, let's assume that it does. The other 2 were just based on our chart. If we go from 175 to 195, that's a $20 increase. And you'll notice that my projection here was about a month from today out to the middle of April. Okay. But guys, we've accomplished what we set out to do today. I do consider this to be a very important discussion. How are options priced? What causes those prices to change? How might we calculate future expected values of options as the variables impact those prices? And what's the role of the market maker? So I hope that this has provided some insight into this important area of options trading. It does take you a little bit of time to wrap your mind around. This is probably 45 minutes where you might want to go back and watch it again. So, as a final reminder, make sure that you are subscribed to our Trader Talks channel. Our Trader Talks channel on YouTube, which you can subscribe to just by clicking on the subscribe button down below, is where you can join our live streams. You can also find our playlists. Now, Mike and I would also suggest that you follow us on social media. It's the place to connect with your favorite Schwab presenters in between the live streams. So you can find Mike and me on X. You can find Mike there at Mike Fairborn CS. You can find me on X at Cameron May CS. But I'm very active on X. And when I make a post, if you read the post and reply to it, I just reply right back to you, as long as it's not some highly sensitive thing that I don't want to touch. It allows for interaction when the camera's not on. And you can also do that on LinkedIn. Just go to linkedin.com/in and then /Cameron May CS. And you can find me there, reply to my posts, and have some communication with me. All right, everybody, it looks like 162 people made it all the way to the end. And 54 of you have already clicked the thumbs up button. That's always appreciated. If you like one of our webcasts, click the like button. It's not just to express your appreciation, which it certainly does, but it also gives my video a nice little boost in the YouTube algorithm, helps more people find important discussions like how options are priced. That's a big deal, right? Now, yeah, time for me to let you go. Everybody, thanks for giving me your time today. I will look for you in a future webcast. I'm also going to keep an eye out for you on social media, on X and on LinkedIn. But whenever I see you again, until that moment arrives, I want to wish you the very best of luck. Happy trading. Bye-bye.